This is frightening. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, we have a terrifying prediction for the U.S. economy, and this is something that you won't see coming, and even worse, something the political elites won't see coming, because what it suggests is the U.S. economy may be closer to a recession than anyone thinks. And is the end of the East Coast port strike a big win for the Democratic Party? I'll show you why it may not be. And Europe has done the unthinkable. They've declared war on China, an economic war that is. I'm going to show you why workers all around the world are going to lose. Now let's head over to Bloomberg, where he picked today's story up with a headline is U.S. hiring tops all estimates while the jobless rate falls to 4.1%. And on the headline, this is huge news because what it says is a Fed rate cut worked, that Powell is one of the best Fed chiefs in the history by sensing that he needed to cut rates, and that would cause employers to start to bring up new jobs, hire people, would increase consumption, and this is telling us now that the soft landing to the U.S. economy is real. But what if I told you the same thing happened in 2007 and other times right before we had a massive recession? Hang tight, because the reality is too much to believe, as payrolls rose 254,000 in September, beating every estimate. Even annual wage growth picked up to 4%, suggesting that inflation's about to surge back. But what if it's not? That is the interesting case here, because this is something that nobody sees happening. We take a look at the unemployment rate shown in blue that's now dipped to 4.1%, suggesting that, as Fed Chair Powell said, he wanted to see the peak of unemployment right at 4.2%. And what this indicates is that he nailed it perfectly and timed the big rate cuts with actual extreme perfection here. But let's take a further look as we start looking at total incomes, now shown as average hourly earnings multiplied by average weekly hours of production and non-supervisory employees. This is shown in red against the year-over-year rate of change. And what I want you to see is, going into the early 1990s recession, what happened with the unemployment rate, it was rising and then started to dip down and give people the confidence that perhaps a soft landing was being achieved. But at the same time, total income growth was slowing. Next thing you know, the unemployment rate surged. As we look to the dot-com bubble, we see the same thing happen again. The unemployment rate starting to bottom and rise, then it dips down once, it dipped down twice. At the same time, we see total income growth falling. Next thing you know, we're in a big recession. How about 2007? We see the same effect. The unemployment rate is curving higher, then it dips down. Everyone starts to celebrate. The problem is consumers didn't have the income to power the economy. Next thing you know, it spirals out of control. And here we are once again. You see total incomes for households is continuing to shrink here on a year-over-year rate of change against a rising unemployment rate. This dip to 4.1% doesn't mean anything in the bigger picture. What it suggests is perhaps we're closer to a recession than anyone wants to believe. But this headline report is going to cause a lot of bullish sentiment into stocks. It's going to cause central bankers to think they got this thing perfect and maybe only need to go a quarter basis point cut in November, if one at all. You can see the dangerous direction, and I'm going to show you there's another chart that suggests it's even worse than what we see, because I want you to note what the media is not covering here, and combined with data earlier this week showing that demand for workers is still healthy while layoffs remain low. The payroll report is likely to alleviate concerns that the labor market is cooling too quickly. But what did we hear in all of the surveys? We've looked at the ISM manufacturing sector and S&P Global. What are they telling us? That companies are laying off. What did we just hear in the services sector? Demand went up, but however, we still cut employees. And so what we're seeing in the survey data is completely different than what the government's telling us. The problem is the government doesn't make policy based on surveys. Makes policy based on what the Bureau of Labor Statistics tells them. Fed Chair Jerome Powell this week reaffirmed that shielding the labor market was part of the reason why the Fed decided to kick off its easing cycle with a larger rate cut in September, making him look absolutely brilliant here. And I guarantee you, over the next couple weeks, you're going to hear the Fed speakers say, hey, you know what? We got this. We voted for it. We knew this was what the economy needed. And look what happened. Maybe we won't even need to cut in November. Maybe perhaps just a a quarter basis point cut, but they're going to champion this until they find out in a matter of months they got it wrong. As Powell and his colleagues believe no further cooling is needed to bring inflation down to the Fed's 2% target. And I'll agree with that, because any further cooling of the labor market says we're not going to just hit the 2% target. We're going to go blowing right through it to the downside. But let's talk about the Fed and their ability to save the labor market, because that was Powell's move by cutting the funds rate last month. And what we see in the unemployment rate in blue against the federal funds rate is, despite the fact that the unemployment rate rises here going into the 90s recession, the Fed is aggressively cutting rates. It did nothing for the labor market. Now here around 1995 through 1997, you see the Fed cutting rates, and it did start to help a little bit, but we still see the unemployment rate kind of flatten out here. How about going to the dot-com bubble? No chance that the cutting of the funds rate did anything to save any jobs any more than it did at the global financial crisis. But right now, once again, everybody believes, because the Fed tells them so, that if you cut rates, that people will keep their jobs, spending will go up, companies will hire, and so far, all we have is one report that says everything looks great. The problem is, it's the trend, my friends, and it's headed in the wrong direction. The solid report could give a boost to Vice President Kamala Harris as she heads into the final weeks of the presidential election race that's focused on voters' view of the economy. Love to know what you think. Is this report a huge win for the Democratic Party or for the Republicans, or does it not matter at all? Who do you think this report benefits? Weigh in the comments below. Love to hear from you, because Fed officials also pay close attention to wage growth, and that was up. But there's one thing so far that this article is not covering, and just hang on, I got that for you, as it can help inform expectations for consumer spending, the main engine of the economy. Hourly earnings rose 4% from a year ago, the biggest advance in 4 months. And what is that going to suggest? That inflation's coming back. And then all of a sudden, the Fed's going to be on the wrong side of this trade. They need to cut and stop cutting, that is, so that way they can keep inflation under control, because wages are back. And next thing you know, the unemployment rate's going to keep falling. Jobs are being created. And you see this soft landing narrative play out in the data. But again, they're missing the bigger picture here, because wage growth for production and non-supervisory employees cooled to 3.9%. So most of those big increase in wages went to, of course, executives, but that's the only part of the issue here. The participation rate, which is a share of population is working or looking for work, held at 62.7 for the third month. The rate for workers ages 25 to 45, notice prime age dropped to 83.8, suggesting people are headed back to work here, and in a big way. But does the participation rate matter? Not at all. In fact, when we look at the unemployment rate, it's the labor force participation rate. You see virtually, no correlation here. One does not mean anything to the other. You can see when the unemployment rate rises, the participation rate, doesn't do a whole lot. It dips a little bit, but that's about it. So nothing of notable interest there. But what we did see, what nobody bothered to cover in the mainstream media, is average weekly hours drop from 34.3 to 34.2. And you might think, wait a minute, Steve, 1/10 is not really a big deal here, but it is. It's a huge deal, because that means that people who did work did make less money because they had fewer hours. And even though some people did get a pay raise, not everyone did. But the issue here is that's less spendable money going into the economy. But this is also a huge prediction for a recession, because what you don't see in the headline data, what you don't see in the non-farm payroll report or the unemployment report, or of course wage increases, you do see it in hours worked, because it starts to make sense. When you go into recession, what happens? You see employers cut jobs. That's exactly what happened in the unemployment rate. That's what we see, jobs being cut. What do we see in the survey data? Jobs being cut. But if you're an employer and you're cutting jobs, what do you want to do? Keep your key employees, keep the productive ones. And so what do? You give them a pay raise, which shows up in the hourly earnings reports, and that gets everyone excited, say, hey, look, inflation's coming, people are going to be spending more, and then they cut hours. That is the game changer here, my friends. Because when we separate average hourly earnings from average weekly hours of production of non-supervisory employees, we can see here in blue that average hourly earnings rise going into recession. This is very normal. People think this is good, but look at what happens to offset that is weekly hours go down. So while people are getting a pay raise, they're working less, so they're really not making more money, which is exactly why we like to look at total income growth, because we see that continue to trend down. That is what, of course, the political elites can't see, is despite earnings going up, consumers have less money to spend. That's why we end up in a recession, and you can see this effect, going into the next recession in 70s here, in the mid 70s, that is. You see rising wages, slowing hours. You see that happen here again going into the 1980 recession. Once again here in the one in the early 80s, rising wages, keep those who you want, but still cut their hours. Again, going into the 90s recession, there you see that relationship. How about the dot-com bubble? You got it. Again, global financial crisis. This time, there's a threat that inflation could go higher. I don't think it does, but the issue here is hours worked continues to trend down. That is the risk, that people have less money to spend in the economy. And when you have less money to spend in the economy, you don't get a soft landing, you get a recession. That is the risk here. And you can see more evidence of that if we look at the unemployment rate just now against average weekly hours of production and non-supervisory employees in red. What we see as hours worked get cut, well, that means people are hitting the unemployment line, because that tells us there's a lack of demand in the economy. You see this relationship over and over, and just because the unemployment rate ticked down and we see hours worked went flat doesn't mean the trend changed at all for the economy. But one thing that should be changing for you is how much money you're making in the market, because I want you to make a ton of money, and we don't even charge very much. But check this out, that uranium trade is up big again today. I know you missed out, but you don't have to miss out on trades going forward. Look at this, it's at 14.47% as a close of business yesterday, surging higher today. Could you imagine making 14%? Well, in less than a month. Well, you could have with our CTA Timer Pro, because we look at machine positioning each and every day, and when we find that the machines are in deep short position and price moves against them, we flag them on the report. But we go even further. We actually give you our view on what we think of that trade. And coming soon, we just did a full back test. We gave it to all our subscribers. We're going to add a new part to the report that shows the hottest of the hot trades, the ones where you have a high percentage chance of making money. You got to get in on this before I release that, because once I do, the price is going to go up, because the win rate is going to go through the roof. Right now, we got 5 open trades. All of them are up. Momentum Timer Pro, we picked up some trades earlier off this week. Some of them are not performing too well, but we see them turning around soon. If you like to trade momentum, this report is outstanding. We give you the edge. We're running the back test on it right now, but here's how easy it is to make money. 2 hours before the market opens, we give you the reports with my opinions. You have to place a trade and go about your day. All you have to do later is come back and put on a stop loss, and we give you the updates once a week. Whether you do it or not, it's up to you. But when you get stopped out, you profit. You don't have to babysit this. You get the reports, the tradable signals, my opinion, the full back test data. Nobody does that for you, and we did it. Why? Because many of you said, Steve, is your stuff really that good? And the answer is yes, it is. The back test proves it. We give you stop loss level, full tracking of all the current trades and returns, update on the stop loss levels every Saturday, fully duplicatable system, and a 30-day free trial. Links in the description below. But right now, the Democratic Party is calling a big win as workers go back from the strike. But is it what they think? The answer is no. As U.S. dock workers go back to work as talks extend into January, and this is a big deal because going to the holiday season, going to the election, this is the last thing the economy needs. You shut down the ports for months on end, you're going to watch the U.S. economy go right into a recession. We're going to receive 61.5% increase over the next 6 years. We're going to have other language to protect us from automation worked out over the next few months, and other issues we need resolved. This from the union, who's getting a big raise here over the next 5 years. But one of the issues is, now that workers believe that inflation is going to continue, they're going to demand higher and higher wages over a period of time. What's going to happen is employers are going to be forced to automate even more, because they're going to need to cut expenses. They know that consumers can't afford these higher prices. So you're going to see wage growth, hours worked get cut, automation go up. It's going to lose in the end here, but in the short term, it looks like a huge win. And the deal neutralizes a potential political issue for the White House in the campaign of Vice President Kamala Harris. A prolonged strike would have forced her to confront a crisis that fueled inflation Well, that's a problem because inflation is only going to be the small part of the next crisis, because when you look at inflation, they're going to celebrate a huge victory. Hey, we got people back to work. Yes, they got raises. This is wonderful. And we're going to avert a recession because look at the payroll report. Look at what the Fed did. We've got this thing nailed. Until you look back at history, and what you find out is periods that are marked by rising and high periods of inflation. What happens? You see these gray shaded bars shows that you get a recession, another recession, one year in the 80s, another one in the early 80s. How about the 90s? You see each and every one of these, you bring inflation up, and then all of a sudden you try to curtail it any way possible, and you get a recession, because when you get rid of demand, and that's the issue here, you don't get inflation anymore, and you get a rising unemployment. That's the risk. That's what the government has done here. They just don't realize it, that maybe in the short term, that everyone going back to work is a wonderful thing for the economy, and certainly it is. What they don't realize is this did not stop what's coming. In fact, all it did was keep it from happening even sooner. A recession is in the future here, but retailers are overjoyed as they applaud the decision to reopen ports while negotiations continue, saying it's critically important. And it is, because retailers are struggling here in a big way. They need their holiday goods to sell because, well, they didn't get them in time in years past. This time they said, we're going to get them here early, make sure we have the inventory people want. And we know that real retail sales is sitting negative still. Retailers are desperate. And if they don't see big sales this holiday season, which we know is unlikely because consumers don't have the money, well, that's going to be even more jobs cut. They went on to say the two sides signed a final deal ahead of a new deadline to prevent a repeat scenario in 3 months. Again, this being a big win for retailers. But how about the European Union going to war against China? Well, they had just imposed new tariffs up to 45% on Chinese electric vehicles. This is an issue because we've seen a huge surge in EV manufacturers coming onto the scene, taking away, of course, business from your traditional manufacturers. This means there's going to be losers, and at some point you're going to see factories close up, just like Volkswagen is trying to do in Germany. This is dangerous because the decision by the EU comes after an investigation found that China unfairly subsidized its industry. Well, that's not really fair because China subsidized our whole manufacturing industry, not just the automotive one. They said, look, we're slowing down here. People are going to lose their jobs, so we're going to just have them continue to produce. We're going to dump it on the foreign markets here, and now what we're seeing is foreign markets say, hey, no more, we don't want your stuff, because it's putting our own labor force out of work. It's killing our economy. This is an advantage China has. And now, again, you've got all-out economic war. Beijing denies that claim, has threatened its own tariffs on European dairy, brandy, pork, and automobile sectors. But you see, as once you go down this path, everybody's a loser. As Europe's car industry has been reeling from slowing demand and stiff competition in the world's biggest automotive market of China, where local brands are now dominating on electric vehicles. Volkswagen has caused concern in Germany by considering shuttering factories there for the first time to cut costs. So here's what you can see, that payroll report. It is an alarming issue for the U.S. economy. Based on what we're seeing in hours work continue to slow down and decline against rising wages, it says we're far closer to a recession. When you start getting more tariffs, it ends up putting workers on the unemployment line at a dangerous time. We're at a very convincing inflection point, but watch the media run with this. Watch the political elites run. They're going to boast that they nailed the soft landing. Well, we'll see if they're bragging in a matter of months. And with that, I'm Steve Van Meter. Thanks for watching. Thanks for being fans. Bye now.